Well, welcome to Current Yield, the Grants Interest Rate Observer podcast. And with us today is Lakshman Achuthan, who is the Chief Operating Officer of something called ECRI. And we're going to hear a lot from Lakshman in a moment. But I want to introduce the rest of the cast of characters. To my immediate left is Eric Whitehead, our very well-traveled engineer. Hello, Eric. Don't say anything. And across from me in diagonal direction is the great Evan Lorenz, Deputy Editor of Grants. And I am Jim Grant. And I'm a little bit post-party because we had our, not postpartum, post-party. We had a conference on Tuesday, right, Evan? It was the 35th birthday celebration of Grants Interest Rate Observer, folded into the annual fall conference we put on. And I'm going to say, Evan, this is in a dispassionate and objective way. I'm going to say it was fabulous.
It was great.
What do you think? Yeah.
I think the champagne at the end was only half as good as the conference, and it was good champagne.
I told Eric to get the second most expensive. Well, okay, fine. If it was that good, it was that good. We'll pay for it later. Like paying for other things, right? Like QE and the such. Yeah, enjoy now, pay later. But as I say, today we are, first of all, this is a commercial enterprise, so we're sponsored by us, Grants Interest Rate Observer. And presently you will be hearing from John D'Alberto, who is the long-serving, the overseer of our subscribers. He signs them up, and when they choose to depart, which is infrequently, mercifully, he sees them off with a little sad sales pitch. He's sad at the end because it's not working, but John is going to tell you a few things about Grants you might not know, so he's coming later. But to get down to business and the business cycle, Lakshman, welcome.
Thank you.
Yeah, just to lay things out, to get down to first principles first, the world is a cyclical place, no?
If you're dealing with market-oriented economies.
Right, so we're not talking about permanency, we're talking about things that go up and down and sideways, right?
There's an ebb and a flow in the affairs of men.
All right, and of, let's not forget the others, women.
The women.
Okay, so with ECRI, the Economic Cycle Research Institute, I have the fondest recollection of its origins because I was a great big Geoffrey Moore fan. Geoffrey was one of the pioneers of the study of business cycles. What were his dates approximately? Was he born early in the 20th century, was he?
Yes, early in the 20th century, went through 2000.
Oh, okay. And he was in on the ground floor of the National Business Cycle.
Absolutely. He studied at the knee of Wesley Mitchell and helped create the original leading economic indicators. The Wall Street Journal called him the father of leading indicators.
Right. And he went on to found ECRI with you and Anirvan, right, at Anirvan Banerjee.
That's correct.
At Columbia. Columbia was the hosting institution.
Hosting institution, and we left Columbia in the mid-90s.
With a degree, I suppose. Right?
With a degree in cycles, for sure. And we've been, we set up camp not too far from the original NBER, which was on 39th and Park before it moved north.
Okay. This is very interesting and useful background to the business at hand, which is doping out what happens next in the world of money and banking and commerce, right? So you keep a whole suite of indicators, and among these indicators is a set of leading indicators about inflation, no?
Yes, the future inflation gauge.
Right, future inflation gauge. And before you tell us what it is saying, please tell us what it is.
So it's a leading indicator of inflation cycles, and its primary purpose, its reason for being, is to anticipate the risk of a peak or a trough in the rate of inflation. And that is different and distinct from peaks and troughs in economic growth. And this was a big insight that still is not fully appreciated. Many of the models out there, so-called frameworks that explain the economy, tried to hardwire inflation and growth together. Moore did no such thing. In the wake of the stagflation of the 70s, came to terms with the observation that cycles in inflation can have different timing of peaks and troughs, and they could be long and variable differences.
So let's get down to the immediate forecast, and then we'll get to the whys and the wherefores. So what is the future inflation gauge saying?
It's saying that inflation is cycling down.
To what level approximately? Is it going to go less than zero? We're going to look at a deflation? Is it going to be a moderately lukewarmish 2%-ish inflation? What is it? What consequences is the call?
Well, I think the consequence is primarily one of direction if you're looking for it to go up, and it goes down. So there's a consequence, like we've seen actually for the last couple of prints, of inflation disappointing to the downside, despite all of the headlines that and reasoning for it going the other way.
But it disappoints to the downside in terms of tenths of a percentage point. And I wonder about the accuracy of the sampling. I wonder about the seasonal adjustment, about these things that comprise the constitute this number. There was a book written by the father of game theory, Oscar Morgenstern, called On the Accuracy of Economic Observations. The first edition in the early 50s, subsequent editions. And he laced into those gullible enough to take on face value anything to the right of the decimal point. And he was slightly skeptical of things to the left of the decimal point in the CPI. What do you say to that?
I agree, is what I say. One of Dr. Moore's other jobs for a little bit was being commissioner of the BLS. And so, I certainly heard a lot about the limitations, the innards of these measurements. And absolutely, there's a measurement issue. And for us, I think the key thing, going back to what the future inflation gauge does, is it gets the direction right. So if you're looking one way and the bus goes the other way,
well, it matters
that
matters
a great deal.
It matters a great deal, certainly in the financial markets. I think the consumers are less likely to feel it. But let me get a sense of the degree to which the inflation rate, as observed, as measured, is going to decline. So are you talking about a move of, for example, say, a percentage point, which would take it from an expected 2.8 to an unexpected 1.8, or you're looking for something that goes all the way down to like zero? How severe?
Right.
Or is this the business of the gauge to tell how severe will be the direction?
It is not the business of the gauge.
So
it's a directional gauge, but I will pick on one word, unexpected. I think it will be unexpectedly weak. And a cyclical turn, let me define what that is. It's pronounced, pervasive, and persistent relative to past downturns in the rate of inflation.
Can we not quantify this in terms of printed CPI metrics? So now we're looking at kind of a 2.4-ish, 2.5-ish on the headline number. Are we looking at...
I see. Here's the distance between the question and the answer, is that we do not run econometric models. We do not produce a point forecast. So we can talk about a directional change, and I think we could talk about the difference between disinflation and deflation. And deflation is not on the table, but disinflation certainly is. And that's part and parcel of a cyclical downturn in inflation.
Is it possible, does your model tell you what sectors are actually driving this decline in inflation? Because we've seen wages high, we've seen shipping cost rise, oil's been up this year. Is it possible to say what's actually going to drive this downturn in the rate of inflation?
Well, again, there's a need for a story, right? I totally get that. We don't come prepared with a story. We let the indicators tell us a story. So we have a whole host of leading indicators trying to do this. One, which is crystal clear, is a downturn in the real home price growth. So we have a very, very clear downturn there. And it's possible that the level of home prices will actually begin to decline. So that's part of the story. But when we go to the future inflation gauge itself, it has kind of things that make sense in it. Money, credit, where are the bottlenecks? What's going on with the interaction with the rest of the world, with currencies. All of those are drivers of inflation, sensitive industrial materials prices. These are all drivers of inflation, or whichever one called the last one probably won't call the next turn. So what's very important when I go back to what a cyclical turn is how pervasive is it? Are the majority of the drivers singing together?
The advanced decline line, as it were.
Yeah. Okay. Before there were composite indexes, we all looked at diffusion indexes, and that's an aspect of what we're thinking about here.
If I hear you correctly, Lakshman, the things to know are, A, that the direction will surprise to the downside in the subsequent and future inflation prints, and that perhaps the destination of the CPI will be at a rate that is below 2 and 1-ish, something or other, but in any case, not below 0. Possibly, probably. Is that fair to say? Or
well, with a snapshot given today, all of that sounds quite reasonable. We will have more information in a month or 2 or 3 or 4. And if the future inflation gauge plummets, maybe I'll revise that to being a bit stronger to the
Well, we're going to know more in 3 years, certainly. Hey, here's a question from yesteryear. So one of my favorite junctures in late 20th century economic affairs was that of the mid-'60s, or 1964, the the Keynesian magicians seem to have won. Negligible inflation, very, very strong employment growth, very, very strong GDP growth, and behold. And then wouldn't you know it, a state of imperfection settled in, and it lasted for 15 years or more, right? It was the dawn of the great. So the rate of inflation itself was not a leading indicator of secular inflation. The great inflation began in the mid-'60s, called 1967 or so, bond yields following dutifully, and then some. But the future inflation gauge says nothing about the possibility of a secular shift our inflation affairs, right? You're talking about a direction that might be pervasive and persistent for months, but you're talking about a cyclical rather than a secular thing.
Right. So I would say several months, a couple of quarters would be persistent. And we can't really see farther than 3, maybe 4 quarters with some of our longest leading indicators of growth, which is a separate cycle.
I can't see till next Tuesday. So I'm glad you have a much better distance vision. Let's talk now about, about GDP growth and about the state of the economy. And you have in your bag of cycles, you have something about growth, no?
Absolutely. And that's where we started with leading indicators of growth. And our indication has been for some time now, for a couple of quarters, that the economy was poised to decelerate, not accelerate. And so that's a that's a very contrarian thing to say. And that's actually par for the course. Leading indicators are around turning points are going to diverge from a consensus view.
Lakshman, if I hear you correctly, you're agreeing with Donald Trump. You're saying the Fed's crazy.
Well, I didn't hear him say that the economy is slowing.
No, it's an election year, Lakshman. He did not say that.
No. And I have news for you. Newsflash, the economy is slowing, okay? Despite what GDP is selling you. And maybe this has something to do with measurement, by the way. We were talking about CPI earlier, and GDP is just as fallible. There's the other side of the account, gross domestic income, which is just as good and measures the same economy. And that is slowing. The growth rate there fell below 2%. And that's in contrast to GDP being at 4%. The Philly Fed adds this all up and creates something called GDP plus. GDI, they reconcile GDI with GDP. And they have the rate of growth for the overall economy slowing from a high of 3.2% down to some 2% or so in the second quarter. That's very, very different, and it's consistent with our coincident data, the broader data on the economy, which shows that it's actually decelerating.
Well, you are not in the buy low, sell high business, although some of your clients certainly are. And I don't mean to pin you down, asking you to step out of your métier into the shoes of an investor, but it seems to me that the implication of what you're telling us is that bond yields may not go higher, may indeed go considerably lower, and that if people are worried about interest rates with respect to the threat they pose to the stock market, that perhaps that threat is overblown.
Well, we do not make market forecasts, but to the extent...
Just for this audience, nobody's going to say anything, Lakshman.
To the extent that growth and inflation influence interest rates, okay, I will say that, again, we see growth decelerating and we see inflation disappointing to the downside. So there may be other things that will impact interest rates, but if it was limited to those events, then there's a bit of an anchor. It's hard to really run away.
Lakshman, before we began the podcast, you told me a stat that I thought was pretty amazing, that if you look at the major economies around the world, the expansion in debt over just the last year is 10 times greater than the expansion in GDP. Could you repeat that statistic and also talk about to what degree do supply and demand factor into interest rates and kind of everything else in the economy?
Well, I think it's reasonable to say that borrowing has been propping up growth. The combined debt specifically of the U.S., Eurozone, Japan, and China has increased more than 10 times as much as their combined GDP over the past year. Yeah. Over the past year.
How about over the past 3, 5, 10 years? Is this something new, or is this...
No, but I think the point we were trying to make with this observation is that it's still happening. It's not over. And what's pretty amazing, in a way, if you think about that, plus tax cuts, plus an oil boom, and we still have a deceleration in growth, a cyclical deceleration in growth that these leading indicators picked up, which I think is becoming more apparent.
Plus tax cuts.
Plus tax cuts. So these are all idiosyncratic one-offs that are lifting, but there's a cyclical impetus in a free market-oriented economy that's cycling down. It does that. This is natural. I think what's quite interesting, because maybe people are thinking about the Fed or the markets, or President Trump was talking about the Fed, is the notion that cycling down in growth is something horrible or bad. This happens. It's actually the environment we live in if we live in a free market economy.
Do we?
We still do. We still do.
Lakshman,
it's dominated by market activity.
Even as you are not an investor, nor are you, as far as I know, a governor of the Federal Reserve System. You're not a governor of the Fed, are you? No. Well, it speaks well of you too. If you were, if somebody said, Lakshman, you must no sighing. If you must. You must, for a day, replace Chairman Powell and decide what to do about interest rate rises that are projected. What do you think? Is the Fed going to proceed with what is on the agenda and perhaps turn an anodyne cyclical downturn into something more serious by unwarranted tightening of credit?
It's happened before.
It's always happened.
It's always happened. Also, we obviously have to think about monetary policy in the context of cycles, and it is a bit frustrating when you see a cycle downturn to see all this talk of hitting the brakes, because it seems a little out of sync, and it's also equally frustrating to see a cycle upturn with them hitting the gas full bore. It seems just on the face of it a little silly. I also just one last, since you opened the door on the Fed, I gotta say, the other thing that seems a little odd is, understandably, we had a great recession and a financial crisis, and maybe it called for some pretty extraordinary measures, but that ended, and then you just have cycles. So the idea of a cycle downturn, let alone another recession at some point, it's not the end of the world. We've had almost 50 of them, and we're still here in the history of the United States.
Right, but it seems to me the ideology of national economic policy is to forestall any such thing, right?
Which is a problem, because invariably, if something is cyclical and you're almost guaranteed by whatever your methods are to be late, probably exacerbate the cycle.
Okay, let me ask you that. Okay, so interest rates are prices, and prices are better discovered than administered.
Agree.
So with me, okay, and I say, perhaps you agree or not, I say that the Fed and the Fed's counterparts the world over have twisted and distorted and have manipulated these prices so they've become unrecognizable as prices, and they have been turned into instruments of national policy, which perhaps might explain a 10 times greater degree of growth in debt than in growth over the past year. Right. So, all right, so that's a windy precedent to this question. So, given that we have been privy to these immense distortions and unprecedented experiments in monetary policy, to what extent might ordinary cyclical measures be superseded by something we haven't seen before, and something that might simply overpower the cyclical rhythms?
Empirically, since all this QE exploded, or since the financial crisis, which is a lot of intervention, extraordinary intervention, these cycle indicators on the question of direction have continued to work as advertised. They haven't changed, and this is actually why I'm even here. Okay, I could have been somewhere else.
You're here, Lakshman. We're here because we're pals.
We're here because we're pals. But why am I talking about cycles? Why didn't I go off and do something else? I stumbled into Jeffrey Moore. You just open. I was lucky enough to meet him. Saw that this leading indicator approach, getting the direction right, not worrying so much about the magnitude, was a very robust relationship that he was taking advantage of, not only in the United States, but also around the world. So not only across time, going all the way back to the Grant administration, okay, in 1870.
That was a good one.
To current times.
Well, what about you mentioned the rest of the world? Which is a very big topic, Lakshman. Yes. But do you have anything to impart to our listeners about affairs outside these 50 states?
Well, since, not that anyone listens to us, but since the beginning,
thousands of people at this instant are listening to you.
So listen now. Since the end of last year, it was eminently clear, looking at the leading indicators that we've so described, there is a global industrial slowdown coming in 2018. And lo and behold, it's here. And emerging markets can't escape that. And you've seen what's been going on there. China, despite all the plans, can't escape that. And you see what's going on there. That actually comes back and reverberates to the US because Chinese industrial activity, cycling down quite clearly, brings down their producer prices, which holds down our inflation. These are all linked. And it's very unlikely that the US can de-link from all of that. And it hasn't.
Evan Lorenz, do you have is that a tablet in your lap?
Notebook.
Can you cough up a stock price chart of Toll Brothers?
It's not been great.
Well, let's see it. Show it to the listeners.
I'm holding it up right now.
All right, it's going down, right?
Oh, yeah.
Okay, so this would seem to speak. Let's get back to housing for a second, as being ever so important. So the level of house prices might decline. Now, I'm not sure this is in your indicators, but the interest rate sensitivity of the marginal home buyer be so acute that even a 50 basis point uptick or 100 in mortgage costs be the agent of this slowdown.
It is definitely part of the recipe. The other part is relatively weak wage growth incomes. And for Toll Brothers, or I don't want to pick on Toll Brothers, but a home builder, they're faced with lower inflation in their asking price or maybe even falling asking prices at the same time that their input prices are going up. Some of the tariffs are hitting them. And of course, when you look at the tightness in the labor market, it's probably about the tightest in the construction sector. So their profitability is really just getting pinched.
Well, you have pinched us, Lakshman, with some very, very provocative ideas, and I'm grateful to you for all the ideas you've given us over the years. I think the front page of Grants quotes you this particular issue, saying that you'll be surprised, you readers, with the weakness in the CPI rather than with its strength.
There you go.
Yeah.
Thanks.
So thank you for being here, and Evan, as always, I thank you. Of course, you got no choice working here, I suppose, and same with Eric, who who's interrupts his travels from time to time to be in the office. So Eric, welcome. Thank you. Welcome back.
Well, Jim, these cycles always turn. So what goes down must go up, and we're watching.
So we ought to talk to you again, huh?
Yeah, let's do that.
Okay. Thank you, Lakshman. Now, ladies and gentlemen, this is a special word from our sponsor because it's coming in the voice of the inimitable and the former actor and I guess singer and nightclub thespian John Delberto, who for years and years has been the voice of Grants over the telephone, admonishing you or urging you to subscribe or to renew. So, John Delberto, can you tell the paid-up subscribers what they might be missing? Yeah.
You didn't want me to sing this today.
No, just the straight voice is fine.
Okay, then I'll do that. I wanted to tell the paid-up subscribers, I just wanted to remind you to register on grantspub.com so you can get your issue shortly after the market closes every other Wednesday, to be able to share articles with your friends, family, and colleagues, to avail yourself of our almost 35 years of archives.
That's 4 million words of more or less deathless prose, right?
It's a lot of words.
Yeah.
And it'll take you a while. And also to access our investment ideas page, which tracks our many actionable ideas by ticker in reverse chronological order.
A lot of people just don't do this, right? A lot of people do not know about the web or seem not to be registered on it.
Exactly. We're trying to increase the registration, and many people underestimate the amount of actionable ideas because they have to sift through Grants every other week, and it helps them to be able to go to the page and see all the tickers listed. And also, registration will help you, will enable you to access our Droid and our iPad app as well. Okay. It's very simple. You just click the login button on the upper right-hand corner of grantspub.com, click register, enter your email address and password, boom, and you're done.
Thank you, John.
Yes.
And thank you, listeners, to The Current Yield. Talk to you next time.